Hello and a very warm welcome to Moneycontrol Live. Finally, we seem to have got some good news on the economy. Yesterday, retail inflation numbers have come out, and which shows that India's retail inflation has eased to a 3 month low of 6.77% in October from 7.41% in September. The biggest drop was seen in food prices, which came in at 7% from a 22-month high of 8.6%. Now, why is inflation so important? Inflation is something that economies around the world are grappling with, and it has been highlighted as one of the key concerns for the Indian economy by the government, by the economists, by the policy makers. The RBI has adopted a very aggressive interest rate policy to bring inflation down. So it's a huge sticky point, and it's going to play an important role in the upcoming state elections as well. How does inflation pan out? What do these numbers mean? And is the worst of inflation behind us? Have we crossed that hurdle, that big burden of inflation? Can Indian consumers expect prices to come down? To discuss all that and more, I have with me two very well-known economists, Aditi Nayar of ICRA and Yuvika Singhal of QuantEco Research. Thank you, Aditi, and thank you, Yuvika, for joining us today for this live broadcast. Aditi, let me begin with you. If you could just give us an assessment of how are you looking at these inflation numbers? Can we safely say that the worst is behind us?
Thanks, Shweta. So yesterday's inflation numbers came in just a tad bit higher than our expectations. So broadly, there was no negative surprise that came through in the CPI inflation data yesterday. As far as the subgroups are concerned, they all either eased or stayed flat at the previous month's level. So that's also good news. Only within miscellaneous items, there were a couple of services that actually showed a pickup in inflation, which is something to be watchful of, but it's not alarming. So the internals are quite supportive. However, there is a very large base effect at play, particularly for food items, which is what has helped to bring down the inflation between September and October in a YOY or a year on year sense. Having said that, food prices did go up for some subcategories of the food and beverages index on in a month on month basis. So the consumer is still facing a slightly higher price as far as his household basket is concerned in October as compared to September, even though in year on year terms the inflation rate has come down. And ultimately, it's what is perceived as inflation, as prices. Month on month movements are also very important. So we may not be completely out of the woods in terms of the consumer's experience of where prices are. But if we are in a business as usual scenario, unless there are any other shocks, in a YOY sense, I would say that inflation has peaked and we're likely to see another substantial moderation coming in the next print in November, and then a flattish to modest downtick after that over the next 4 to 5 months.
Oh, that's super. Yuvika, to bring you in here, what are your thoughts? As Aditi said, that we could see inflation tapering further, and from what we can make of it, it seems that the worst might be behind us. Do you echo the same sentiment?
Broadly, yes, Shweta. So I think as readers of inflation, we need to differentiate between, as Aditi pointed out, what is happening on the headline, the YY front, and on sequential momentum of prices. And that is where the actual, watch on inflation would also remain. That while headline inflation numbers will probably continue to taper lower, follow a glide path lower, is the sequential momentum in prices that also need to correct somewhat. So if you would see sequential momentum in prices of the last 3 months have only gathered pace, and more so because of food, as Aditi pointed out. And within food, if we look at the food basket, it's cereals and vegetables which played spoil spot in the month of October. Cereals, as we all know, the story began with wheat and now it's shifted to rice with lower acreage under sowing for the Kharif sowing that just ended. But on top of that, we also saw some bit of pressures coming in on perishables, vegetables, which also happen to carry a high weight on in the CPI consumer basket. And that was largely because October we saw a large amount of unseasonal rains hitting us, which not only affected production and supplies, but also logistics. So put together, I think we would keep an eye on momentum. While headline does seem to be on a glide path lower, but momentum, especially on food, must correct. And I think it's only a matter of time with the winter seasonality kicking in, especially for perishables. We could see momentum also correcting, and that's where we think with the victory be that both momentum and headline coming in lower.
Okay, talking about food prices, it's a very volatile series. It's a very sticky issue, and you're right. Like you've seen some seasonal vegetable prices go down, while you've seen prices of cereals specifically being in a very sticky territory. So yesterday we also got a note from the finance ministry where they said that the measures that they've taken on the import tariffs might have had an impact on bringing inflation down. So if you were to break this down, if we could just talk to our viewers about what's driving these prices downwards. Food prices is one big aspect of it, right? In that, what's the reason behind a certain vegetable prices or a certain prices of certain commodities going down while we see an increase in prices of certain cereals? Anybody who wants to take this? Aditi, over to you
Sure.
actually.
So, there's been a three, four different factors at play as far as our food basket is concerned. As Yuvika said, we started off with a shock on the wheat crop. We had an unseasonal heat wave between March and May of 2022, and that had an impact on the wheat output from last year's Rabi crop. And along with what was happening globally between the cereal issues as well as edible oil related concerns, we entered into a period of high food inflation on the wheat side and on the edible oil side. Now, many measures have been taken by the government for edible oils, for wheat, for rice to be able to bring the prices down, and that's definitely helped matters. Particularly on the edible oil side, we've seen a lot of relief coming in the last few months. But then the next thing that happened was that the sowing for the summer crop of rice, the kharif crop, there the acreage was lower than last year. And the first advanced estimate is also indicating that we're going to have a lower output as compared to last year. So there's now concerns on the size of the rice arrival that we're going to get from this latest summer crop. And after that, at the beginning of October, we had this very unseasonal rainfall, and typically vegetables, are highly sensitive to change in moisture, and heavy rainfall can really have an impact on supplies. So, what we're now seeing is a month-on-month increase in the vegetable prices, particularly for some specific items, and that is leading to this seasonal sequential momentum in prices that Yuvika was talking about. So all in all, lots of different sort of food issues or shocks. Lot that the government has done. 7% of food inflation in a YOY sense is still high. It's better than what it was last month, but it's still high. And it's come down partly because we're sitting on a very high base. So it's not a victory, but at least the momentum, directionally, we're looking at a lower food inflation in October, and that's something we expect will continue next month.
Okay, Yuvika, we also see a difference between inflation in food prices in rural areas versus urban areas. In urban areas, have seen a greater reduction in food prices. What do you make of that? I mean, how does that add up? Because one would think that if the food is, being harvested, vegetables are being harvested. If it's a problem bringing them to the cities, food in rural areas would be cheaper. So that doesn't quite add up. If you could just explain that a little bit.
Right, Shweta. So logistics, as you pointed out, is one part or a markup on food prices or vegetable prices per se. But in total, we also have to keep in mind what has happened in terms of production costs of the agriculture over the last 1 year. And as we all know, the agri input cost inflation has really shot up. In fact, if I recollect my numbers rightly, agri input cost inflation is running in high double digits, somewhere in the range of 25 to 30% over the last several months. And that essentially means that the cost of producing vegetables have gone up for a farmer, and he's pumping in greater amount of money in producing. And that's the reason why you see not just vegetables, but across the food basket, the prices of commodities, food commodities have risen domestically. Having said so, I think what we need to also keep in mind that the unseasonal rains that we have spoken about, the first line of hit is to the production. And immediately thereafter, you would see that prices in both the wholesale and the retail side would rise. And we see that in the WPI inflation number as well. So within primary WPI inflation, food within primary has actually risen in the month of October. And when wholesale prices rise, it's the first line of hit is on the rural side, because somewhere that's the first link from rural to the wholesale. And then it might take a bit of a lag, maybe a couple of weeks or a month, to pass on to the inflation side on the retail side. So any kind of divergence that you might see between rural and urban inflation on the food side is likely to be temporary, with price pressures getting passed on from the wholesale or the rural side to the retail or the urban side shortly. So I will not be surprised that if next month again we see prices of perishables more so on the retail side actually capturing the rural or the wholesale side of prices remaining high in the month of October. So it's only a matter of time before the pass through actually translates.
Okay, so what are your expectations on the interest rate front? Do you think that the RBI will continue with its stance on the monetary policy, or do you think that we might actually see some softening, or are the RBI pressing the pause button on interest rate hikes, Aditi?
So, Shweta, our view is that because inflation is still above 6% in October, and we're expecting a large, moderation in November as well, but we still think it's going to be above 6%. So, therefore, we do believe that the MPC is going to go in for one more rate hike in December. But because of this moderation, we do think that the size of the next rate hike is probably going to be closer to 35 basis points instead of the 50 basis points that we've seen in the last three policy reviews. So a down step as far as the size of the next rate hike is concerned, but we are expecting another rate hike in December. And February is just too early to call. Too many data points between now and then. What is the direction that comes through the budget, etc. So we're not taking a call on February other than to say there is going to be data dependent. But December looks like a smaller quantum of rate hike as compared to what we've seen in the last three reviews.
Okay, Yuvika, your thoughts?
I think I would mimic Aditi's view to some extent. Yes, we are also looking at a lower quantum of rate hike, 35 basis points for December. And I think we need to keep in mind that with this 35 basis points of hike, with the repo rate at 625, and looking at where inflation would be 1 year hence in the range of probably 5 to 5.5, the RBI or the MPC will be offering adequate level of real interest rate anchor to the current state of the businesses. Also, last minutes of the MPC did reveal to us that two of the members of the Monetary Policy Committee did indicate some kind of a policy pivot, a preference for a policy pivot. And that I think should also somewhere weigh in more strongly post the December 35 basis points. So for now, we are saying a 35 basis points in December. Post that, probably RBI should take a pause, or at least take a pause to reflect and see what is happening, what has been the impact of past rate hikes. Like Aditi mentioned, not just data, but we will also be probably looking at the fiscal policy, the budget being announced in Feb. And probably monetary policy will need to become more reactive rather than proactive that we have seen over the last several months.
Okay, in terms of policy priorities, considering until now it's been made very clear that inflation has been the driving point, whether monetary policy is concerned or fiscal interventions are concerned. Going forward, how much of a priority do you think should policy making be giving inflation? Considering now, if you look at the global context, you look at the US economy, UK economy, India seems to be doing better in managing inflation. From a policy perspective, what are the levers that we need to press right now? How do we prioritize policy making from this perspective? Aditi.
So, Shweta, my view is that as long as inflation is above the tolerance level, and our tolerance band is very wide, it goes from 2 all the way to 6%. As long as inflation is above 6%, inflation should remain the priority unless there is a complete collapse in growth, which is being foreseen. And that's not the case right now. So, that is why we do think that the December meeting is going to go in with another rate hike. It might well be non-unanimous, as Yuvika was pointing out, because our reading as well as of the last minutes suggests that a couple of the external members may be more inclined toward pause in December as compared to another rate hike. And absolutely, we need to look at the 12-month ahead inflation, and we also need to look at where growth is relative to potential. So possibly, what we feel is that we should be getting close to the end of the rate hike cycle, and really trying to avoid a, a growth sacrifice down the road. So our personal, my personal view is after a 35 basis points rate hike in December, possibly a pause may be preferable in February, unless it's looking like inflation is going to remain really sort of sticky, 5.5% plus over the course of FY24. If that's not the case, if we look, it looks like inflation is going to be, in the range of maybe 520, 530, then perhaps we can take a pause and let the growth recovery strengthen.
We can't hear you, Shweta. At least I can't.
Can you hear me?
Yes, I can.
Okay. No, I'm saying it's a bit of a catch-22 situation, right? How much between inflation and growth, at what point do you decide that it's sacrificing growth? At what point do do you just go by the book and say that, okay, inflation is above my tolerance level and I'm going to continue sucking out the liquidity from the system? Do you think we have reached that stage that we need to prioritize growth over inflation? Because growth has been a matter of concern as well, but until now, like I was saying earlier, inflation has been prioritized over growth. So what would be, what's your take on that?
So, Shweta, I think we need to keep one thing in mind, that monetary policy always works with a lag. And the kind of action that we have seen of almost 190 basis points of rate tightening is bound to take its own due course in terms of a timeline to bring down inflation. And I think that is where the pause becomes critical, because it's necessary that Monetary Policy Committee and RBI kind of assess what has been the impact of past rate tightening, both on assuaging inflation and on growth in some sense as well. Also, like you said, RBI has prioritized CPI inflation, and rightly so, because inflation has remained elevated. It's been 10 months since it's been above the upper threshold of the inflation targeting band. But also, I would want to highlight that growth is something that, in comparison, not being discussed as much. And if we were to forecast our growth trajectory going forward, and even if we look at RBI's own assessment of growth trajectory going forward, the Q3 and Q4 numbers are in low single digits, somewhere close to 3%. Was transpire in Q3 and Q4, there is bound to be, if I would not say, if I should not say a shift in focus, but some gaining prominence yet again alongside inflation. And I think that's only a matter of time, given how the global economy is shaping up, the downside risks to global growth, its impact on India's external account, India's external sector, and internal growth. I think next year, given that inflation will remain sticky somewhere around 5.5 in the first half of the fiscal year, and growth impulses would probably look much more weaker than they are at this point in time, some kind of a trade-off between growth, inflation, or growth creeping in back into the narrative of the monetary policy, we'll see that happening again. It's only a matter of time.
Okay. How much of an impact do you think would oil prices have on inflation? What's the range that we are working with at this point? And considering the global uncertainty, is there, I'm sure, this is something, again, it's a very volatile situation. So can we expect some unpleasant surprises where inflation is concerned, where considering its weightage, considering the impact of oil prices on inflation across all sectors? Aditi.
Shweta, I didn't hear you very well, but let me respond with what I think I heard you saying. So, on the crude oil side, the range we're working with is about $90 to $105 per barrel. In the winter months, there's always a little bit of a tendency for crude oil prices to go up, and if OPEC is going to cut production, then there could be a little bit of hardening from these levels. And also, news, there's been a lot of volatility volatility as far as the news flow is concerned about the market coming back, and then valley phase, including that is something that prices volatile range. So 90 to 105 is what right now. Now crude oil prices and prices of crude oil derivatives have a big impact and translate very quickly into the WPI as well. So there we see that the pass through is quite rapid. It's reasonably sort of uh, quick. And but as far as the CPI is concerned, crude oil doesn't meet into the CPI basket. What is CPI basket? Petrol and diesel. And actually, crude oil prices doesn't it immediately direct impact prices of petrol and diesel going to move freely as the crude oil prices move globally, or is that something that is going to be kept at a stable level to sort of cushion the economy from this global uncertainty and volatility?
Okay, I'll just take off from the point that you had made earlier, Aditi, that we could see stress points emerge, say, in housing rents going forward. Certain areas where we could see elevated inflation. Could you elaborate a little bit on that? And Yuvika, same question for you. What are the areas that you see as stress, as stress points where inflation is concerned? Could you guys hear me?
I could.
Okay,
I'm
Yuvika, why don't you respond to that?
Sure. Shweta, so I see multiple stress points. One, the multi-pronged pressures on food that we have seen, stemming from largely cereals, but also some perishables. I think that is one stress point that we would want to keep an eye on. We have already discussed the global commodity prices, but just to add that as long as crude prices remain below 100, I think we are fairly okay with the 90 to 100 kind of a range. I think India in general and for inflation numbers, that's a good range for oil prices to be in. But having said so, I think oil price is something that is extremely exogenous, and we would only be hazarding a guess of where they could go globally. The other stress or a risk factor is coming from definitely core inflation. And we see that stickiness in core inflation lingering despite the softening that we see or we saw in the October CPI inflation. And if you look at certain services, and this is the point Aditi also highlighted, that within services, there are pressure points with the economy opening up, people starting to move out, almost inching to a normal life. We do see price pressures in, say, for example, airfare or maintenance charges, or prices of in the tourism hospitality sectors that would also, interestingly, if you notice, in this October CPI inflation, there was a significant upside in housing prices, and that to our assessment could somewhere be coming from the back of the payouts that we saw coming from the government, whether it was in the form of a hike of a dearness allowance or some kind of bonuses that were paid out to a large number of central and state government employees in the run up to the festive season. And typically, these housing inflation is strongly linked to rents and rents of government dwellings, which could have captured those windfall income gains in some sense in terms of resetting of rents. So, it's multiple factors, like I said, food being the biggest, along with some impact of global commodity prices, core inflation on the demand side, are some of the risks that we would keep a watch on.
Okay, Aditi, can you hear us?
Yes.
All right. I'll just pose a question again to you. You did highlight some of the stress points that could emerge. Services is one. Can you elaborate a little bit on more on that? And what are the areas where we could see inflation actually getting accelerated?
Sure, Shweta. So, services demand is very robust right now. Ever since the economy has opened up out of the lockdowns, what we've seen is that as the fear factor has gone away, the demand for contact intensive services is really, really strong right now as far as discretionary items are concerned. Things like, travel, leisure, hotel stays, airline traffic. We're seeing very strong demand on these things, but also some basic services like education and health, which also saw a lot of disruption during the lockdowns. The demand for these is also back. And in fact, when we look at yesterday's data, as I was saying, most of the major sub indices either saw a flattish or a decline in inflation between September and October. But when we break down the miscellaneous items, health and education are two which stood out, which actually saw the YOY inflation going up. And this is something that we need to be quite cautious of, in addition to other discretionary services as well. How really consumers spend and where the demand is going to be sustained and strong, that is likely to end up eventually seeping into higher prices over a period of time. And therefore, we believe that the core inflation component, which is the inflation stripping away food items and petrol and diesel and fuel and light, that is something that is likely to remain quite sticky going ahead. So we need to be quite watchful of how the demand in the economy is going to seep through into the services inflation, along with, of course, food inflation, where we've already talked a lot about the stress points which are there as far as food items is concerned. But I just want to add one sort of positive factor. The reservoir levels are at very healthy levels right now, and that is something which gives us a lot of
You mean
insurance.
a food green reservoir levels? That's what
the
you're referring to?
the water reservoir levels.
The water reservoir. Okay.
Yeah.
Hmm.
So since we've had this excess rainfall, particularly in the later part of the monsoon and in early October, so the reservoir storage is quite healthy right now, and that's something that should hold us in good stead through the winter cropping season, and also take away a little bit of the uncertainty in case the next monsoon is late. Then at least the sowing doesn't need to be delayed if the reservoir levels are healthy. So that's a little bit of insurance going ahead as far as the crop outlook and the food inflation outlook is concerned, amidst a sea of uncertainty.
Okay, no, that's a positive, encouraging note. Okay, my concluding question to both of you is that we are months away from the budget. Any suggestions, any recommendations, anything that you think that the finance minister must address in this budget? Yuvika, let's begin with you.
Sure. I think two points that come to my mind at this point is one, that the fiscal consolidation that we have seen in the last few years should continue. So there should be a sincere attempt to bring the fiscal deficit number even lower now that we are out of the pandemic kind of a situation where some kind of spending was necessitated. But I think we are no longer in that kind of a zone, and there should be a sincere attempt to bring the excessive expenditure, especially related to the COVID and other certain schemes which saw the light of the day during the COVID pandemic period, should now be normalized. One. Second, I think from a fiscal perspective, the kind of shift that we saw in favor of capex spending and how that has served the economy in terms of supporting growth and creating assets and investment in the Indian economy, and trying to probably crowd in private investment is something, a focus that we expect should continue in the budget. All said and done, I think this will be a budget ahead of state elections and bigger elections the year thereafter. And I think somewhere we'll have to keep that in mind, that some of the schemes which did see the light of the day might not be extremely easy to be done away with. But nevertheless, I think even if incremental steps are taken to withdraw some of the excessive, expenditure or excessive schemes that we saw in the pandemic years, I think that would be a really positive from an analyst perspective.
Wow, Yuvika, your suggestion is a political war field, minefield. Okay, Aditi, your thoughts on the budget. What would you like to see in the budget?
So I'll stick to just one thing. We saw a very large increase in the interest-free capex loan allocation for the state governments in this year's budget as compared to the money which was on the table in the last 2 years, and that the states perhaps were became aware of only when the Government of India budget was unveiled, that there was going to be such a sharp step up in the money that was available to them. And what we saw was that some states hadn't even included the allocation in their budgets, and the offtake was rather slow through the first half of this year. Only in October, November, we're hearing that the amounts that are being off-taken have gone up. So, in case this scheme is being continued, and what is the allocation, how large it is, if that can be made known to the state governments early enough that they can budget for it and plan for it, then perhaps we can start seeing the outlays much earlier in the next fiscal year, so that the amount which is available can actually be spent in its entirety. And I think that is something that will really help the fiscal impulse of growth as well. So if this scheme has to be continued, then what is the allocation? If that can be made known to the states early on, then I believe they'll be able to plan to spend that money better.
Okay, very quickly, do you see inflation playing havoc with India's macro numbers? I mean, what kind of an impact do you see on India's current account deficit and fiscal deficit because of inflation? Yuvika?
No, I don't see. I see following a glide path lower, and I think that should be seen in a positive light.
Okay, Aditi, do you see any impact on budget calculations that were made, for this fiscal inflation impacting those calculations?
See, as far as inflation is concerned, what we're also seeing is that prices, since they're higher, the taxes that get collected on certain items also end up on the higher side. So whether it's the indirect tax collections, other than excise and customs, or the direct tax collections, we're seeing a very healthy growth right now. So in spite of inflation, or maybe partly because of it, we are seeing the tax growth, ex excise and service tax and customs duty being quite healthy. So I don't think that that's going to have a negative impact on the budget math. There's lots of positives and lots of negatives, but we believe that the fiscal deficit overshoot is probably going to be quite limited and quite, it's not going to be a situation that is going to be alarming, or we're not expecting there to be a large increase as far as the borrowing program of Government of India for the second half of this year is concerned. For next
Okay.
year, possibly we should expect a modest decline in the fiscal deficit. And one big question is going to be, what is the market determined level of fertilizer subsidies? So that's not a policy decision, that's effectively something that we have to deal with. And fertilizer subsidy is something that has gone up tremendously this year because of the supply chain issues, and because of what's happened with global commodity prices. So that's something that we'll have to take as a given and sort of just work into the budget math for next year.
All right. Well, thank you so much. So clearly, inflation continues to be a tightrope walk for the government, for the RBI. It's still above the comfort level, and we cannot wish it away just yet. But things are looking much better than what they were. On that positive note, thank you very much, Yupika. Thank you very much, Aditi. Have a great evening, and we look forward to having you back on Money Control. Thanks so much. Bye.
Thank you,
Thanks,
Shweta.
Shweta. Bye.